I'm here today with Markus Brunnermeier, the Edward Sanford Professor of Economics at Princeton University. We're here to discuss the book that he wrote with Harold James of Princeton University and Jean-Pierre Landau, the former Banque de France governor, The Euro and the Battle of Ideas. Markus, thanks for joining me.
Thanks for having me.
Markus, you talk about the contours of Europe, and you zoom in very quickly on the relationship between Germany and France. But why is that the focal point when we've all been talking about now Italy, formerly Greece, and Greece, and Greece? Why do you see that as the fulcrum where the battle of ideas takes place?
I think, the major debate is really between France and Germany. And the reason for this is that actually there was a huge power shift in the spring of 2010. So initially Brussels was very influential, but then there were certain decisions taken, like the involvement of the IMF and other decisions, which shifted first the power away from Brussels to the capitals of all the member states of the European Union, and then later the Deauville decision, which essentially said that there would be a debt restructuring in Greece, which shifted very much to Paris and Berlin, but primarily to Berlin. And that's why the battle really occurred between Berlin and Paris. But having said this, it's not really these two states which battle everything out. There are many states like Finland, Netherlands, which are very much like Germany. And there are other states like Spain, Italy, which are more like the French. So they have different perspectives on many, many economic issues.
This is interesting because France, when I look at bond spreads, I used to trade these bonds, very narrow spread relative to Germany, but they act more like Southern Europe. And many people have wondered, when would France essentially team with Latin Europe, the France, Italian, Spanish coalition form vis-a-vis those northern countries. But France tends to stay on both sides of the bridge. How do they do that?
Yeah, so especially Sarkozy was always very keen to stay in the shadow of Germany in terms of being part of the core, with the German-French axis to drive Europe forward, the integration process forward. And now not to alienate the Germans too much. So he was very keen to balance this. On the other hand, to also push and bring the Club Med essentially together and form an alliance with them and push their own economic philosophy forward against the different one that Germany pushes for.
Let's talk about what you might call the two sides of the battle of ideas. How would you characterize or compare and contrast the German view and the Club Med view?
I think there are probably four dimensions which play out very strongly. The first one is rules versus discretion. So the Germans, they like rules, everything has to be automated ex ante, while the French like very much a discretion. So if you have a state which can intervene, or a president or a king, a very centralized state, you can intervene in times of crisis very aggressively. So you do a lot of crisis management. If you have a very federal state, then actually you need to do much more ex ante. You have to look forward and design rules how things will play out in terms of crisis. So the Germans focus very much on rules, while the French focus on discretion. But it's not actually so simple in a sense that the French economic philosophy has very strict commitment on certain dimensions. For example, they would never default on debt. Or they would say, we don't even specify an exit from the Eurozone. So we make it very hard. On certain dimensions, they really commit very strongly. But this requires in other dimensions to be very flexible. So the first debate is this rules versus discretion.
And that's interesting. You characterize the difference in the structure of government. The centralized government can use discretion and be responsive quickly. You need rules when, you might say, the government process becomes bogged down because there are many cooks in the kitchen.
Exactly. So that's the first dimension. The second dimension is more about solidarity versus liability principle. So on the one hand, when there was a debate, should we pay something to other countries, it went through the French parliament very easily. The German parliament was very resistant. And that's because the underlying philosophy, again, is different. From a German perspective, there's this liability principle. So if you are in charge of something, you're also liable for it. So you cannot separate the things. If you're in charge and you have the control over certain decisions, then you also have to be liable for it. So this liability principle is very, very strongly pronounced.
There's a correspondence between responsibility and the, consequences of exercising that responsibility. So the French couldn't go past their budget, and if they did a bad job, have the Germans pick up the tab.
Yes.
That-
So exactly,
that-
that's
yeah.
essentially
Yeah.
what's going on. So, and then the next thing, which is very tightly connected, is this liquidity versus solvency dimension. Where, on the one hand, the French, whenever it's unclear, they think it's always a liquidity problem, and you just need a big bazooka. And once you have this big bazooka showing strength, the markets will flush, money will flow again, and everything will be fine. While the Germans, whenever it's in a gray area or when there's uncertainty, they think it's a solvency problem. There's a fundamental problem. You have to fix the fundamentals, and there's a very huge difference. And why is it so connected to the previous one? If it's purely a liquidity problem, then you can help out, you can show solidarity very easily because it doesn't cost anything. If it's a solvency problem, it's a fundamental problem, and then you don't want to create, some huge transfers down
Don't
the
throw
road.
good money after bad or whatever.
Exactly.
People say we got to improve our crisis management system. Once a crisis onset, how do you manage so that the economy doesn't break down? And that's a good thing. But that, what you might call mitigation of risk in the event of a crisis, encourages more risk-taking ex ante. And the political economy in the United States of how to exercise prior restraint on bubble formation is a very difficult thing. Volcker used to talk about taking away the punch bowl.
Yes.
Nobody wants to spoil the party, least of which is the legislature executive branch that needs a war chest to run for re-election when the financial sector is holding fundraisers.
Yeah, so you have this all over the world, the same problem. What makes it more difficult in Europe is that it has redistributional consequences, not only within the society, but across countries. And every politician is elected by his own national people. So that's essentially which makes it even more difficult to say. Even if we know how to solve it and intervene there, said, some certain nations have to chip in something, but others will benefit more than proportionally. And that makes it politically much more challenging.
So right now, before we go to your fourth dimension, let's talk about current circumstances. There are a number of banks who are discussed about in Europe, in many of the countries, on both the Mediterranean and the Germanic side. What do you see as the bailout, bail-in balance? How would you take action in light of what we're hearing in the news about these particular challenges?
So yeah, exactly. You mentioned already bail-in versus bail-out. So if you think it's a liquidity problem, you should just bail out and it's not a big problem.
Yes.
If it's a solvency problem, you want to bail in and you want to avoid future moral hazards. So all the bondholders who essentially gambled with this country or this bank, they should actually also not only take gains on the upside, but also take the losses on the downside. And then there was a radical shift in the attitudes within Europe with Cyprus. So when Cyprus in spring of 2013 was not doing so well, and then there was the question, what should we do with the banks in Cyprus? Should we bail in or bail out? And that time, the French side was arguing, there might be some systemic risk. If you don't bail them out, it spills over to others, so we should actually lean towards bailing out.
So the nature of the spillover is that if you penalize depositors in Cyprus through a bail-in, others will learn from that example, and you'll have bank runs in other countries that precipitate a crisis.
Exactly. So then it said it might be spilling over to Italy, Spain, and other countries. And this actually gives then the country in question a lot of bargaining power. Said, you have to bail us out, otherwise we create a lot of spillovers. And at that time, the German attitude was always Cyprus is systemic, where mostly the depositors were, to a large extent, the big depositors were Russian oligarchs.
Yes.
Then everything is systemic, so we can forget any of the bail-in. And then there was a decision made that there will be, to a large extent, some bail-in. And this bail-in then led to a whole new framework, which led to this bail-in framework we have currently. And because of this framework, it makes it very difficult now to bail out the banks in Italy or even in Germany, which are in trouble currently.
Yes.
So while you saw before the crisis, or when the US crisis spilled over to Europe, there was a lot of bailout in Germany, activity in Germany in 2007, 2008, and even in Spain, actually the Europeans pushed the Spaniards to bail out their banks. At the moment, the framework is such that it's not so easy for a country to bail out their own banks.
And this is a very, important and very vulnerable tinderbox, because, just to use a statistical way of expressing it, the ratio of bank assets or liabilities to GDP in Europe is much, much higher than in America. So the vulnerability of the banking system is a much bigger, how we say, disruptive potential than even in the United States.
Yeah, there are two reasons for that. So why banks are so important in Europe. The primary reason is that unlike in the US, capital markets are not so developed. In the US, you have essentially bank funding, but to a large extent, many corporations can go to the corporate bond market to fund themselves or money market funds. And there's a lot of other funding going on outside of the banks in the United States. In Europe, it's very, very bank dependent. So it's essentially a more traditional model. And the bank dependency is much more pronounced in Europe. The second reason is that before the crisis, many of the European banks became global players, so they used funding from abroad, including from money market funds in the United States, and then passed it on to other parts in the world. And that's when, as soon as the banks get in difficulties, that actually drags down the whole economy in Europe. And that's, I think, understanding the banks is therefore crucial. And also it's crucial to fix the banks in order to get back to economic growth.
I know your friend Hyun Shin, who's now at the Bank for International Settlements, was a co-author of a paper on the end of the, what do you call it, the triple coincidence, about where a bank's located, what currency you're denominated in, and where the borrower is, so that you could have a euro-denominated loan in the UK by a Chinese bank.
Yes.
And all of our balance of payment statistics and everything else are, how would I say, misleading if you look at macro adjustment through that lens. So the complexity of the financial system and what happens in Europe can take on many different forms. And does the BIS, we call on Hyun, does he have good enough data that you can see these patterns and flows at this juncture?
I think the data is getting better and better. So after the crisis, actually, there were huge reforms to collect more data. And the data is actually coming in as we speak, and it's getting better and better.
Yeah.
I think what's a good sentence, essentially, what makes actually capital flows across borders so different from capital flows within a country is essentially that the saying which says, global banks are global alive, but national at death. And it makes very, once they go belly up or something is going wrong, then the question is, what is actually the national authority? How much taxing power do they have? How much can they bail out banks or cannot bail out? And where the banks located matter suddenly a lot. And before the crisis, nobody really worried, where is the bank located? How much fiscal capacity does the state have to potentially help out a particular banking sector? But now we're much more alerted, what's going on this dimension.
Well, our mutual friend, Philip Hildebrand, when he ran the Swiss National Bank, was looking at two banks that constituted 800% of GDP. So their tax base was not credible.
Yes.
For
so that's essentially for Switzerland in particular. You have a huge banking system, which tax base is much smaller because Switzerland is a small country. Of course, the Swiss banks now realizing this after the crisis, they shifted the whole business model much more to wealth management and being much less traditional banks relying on demand deposits and investing in other dimensions.
But these entanglements are very interesting because, as you were talking about, the European banks were very involved in the American money market and mortgage derivatives and so forth. And what happened with regard to Lehman Brothers and the mortgage crisis ended up leading to very, very substantial balance sheet contraction of European banks.
Yes, so the European banks were exposed, and because of these losses coming initially from the US, it spilled over dramatically to the European system. And then the European political arrangement was not in shape in the sense that it could respond as aggressively as the US could respond to the challenges. And that's why the situation dragged on for so long.
So now you're looking at the liquidity and solvency principles. Banks on both sides of, let's say, the Mediterranean argument are potentially either bailed in or bailed out. You've got consequences for all the different countries and maybe beyond. How do you see this unfolding? How, if you're giving guidance, how would you navigate these rapids?
So Europe always essentially integrates through crisis. So essentially, whenever there's a crisis, new measures will be undertaken, like a banking union, and also so Europe is actually strengthened typically by a crisis. But this crisis is so big and it also revealed that the underlying ways of thinking are so different that it's a much bigger challenge than previous crises. And what this book tries to do, it tries to spell out these differences in economic thinking, makes it crystal clear, where are the differences in these various dimensions. And the hope of this book is to make it, as a first step, the policymakers have to realize it's very different, the way you were thinking. And then you find a common way forward. And why do we think there's a hope? The hope is that the economic philosophies are not written in stone. They actually change over the centuries.
So we can have discretion regarding when to change the rules and what the rules should be.
Yeah, so typically rules can constrain discretion, so you always have some, some remaining discretion left. But what's interesting, if you look after the Second World War, the sides essentially switched between France and Germany. So you had before the Second World War, France was very laissez-faire. There was not so much central planning. But this, austerity measures and cutting in military spending made France very vulnerable to the German attack in 1940. And this was then dismissed later on. And then after the war, it was essentially, they shifted much more to a central planning arrangement. In contrast, Germany was very, very much a central planning arranged state, especially under the Nazis.
Yes.
And there was a school of the order liberalists who said, okay, we don't want any concentration of power. And their philosophy was, let's promote competition in order to get rid of any concentration of economic power, also political power. And for the Allies, this was a good thing to have. Let's move power away from Berlin and distribute it across the country. So they actually helped to promote it, and also Ludwig Erhard and others pushed this in Germany very much. And Germany was doing very well initially on this, and Germans fell in love with this arrangement. But what we want to show in the book, and what we explain, that this economic philosophy can switch, so there is hope that actually things will change, or there's some convergence on this dimension. So we don't only need economic convergence in terms of economic numbers, like GDP numbers and productivity. We also need convergence in ideas, or in convergence how we think about these things. And there is hope because things are not written in stone.
So you had rules versus discretion. You had liability versus mutuality, or
solidarity, mutuality,
or solidarity, yes. And you had liquidity principle and solvency principle. What's the fourth?
The fourth dimension is what everybody talks about, is like austerity versus stimulus policy. The French would like to, the economy is slowing down, we need some stimulus measures. The Germans, they say, okay, we need fundamental reforms. I think the fundamental difference is, when should you do reforms? Structural reforms. And if you look at a model, it's much easier to do when the economy is booming. You can redistribute, there's some gains to be distributed, so you can do the reforms much more in good times. But even though you can do it, you should do in good times, politically, you can typically only do it when you're really standing against a wall. So the Germans are very much thinking, you have to use a crisis to reform the country. You can't just stimulate your way out, because you're just hiding the problems, and the structural problems are never fixed.
It's anesthetic.
Exactly. So it's like, the Germans are much more driven by political constraints. And there's this TINA principle, which says there's no alternative. Once you're in a situation where there's no alternative, then you put reforms through. And the Germans experienced that. So in the 2000s, Germany was the sick man of Europe. And then they went through radical reforms on the labor market and many product market and many dimensions. And then they said, it worked very well for us. We grew out of this problem, and now we are the strong man of Europe. And the others should do the same thing. It worked well for us. Why don't they do it as well? And that's a German attitude. And there are many experiences, not only in 2000s, but in 1950s it was similar. There were a lot of recommendations not to do things, but they are focused on structural reforms, and they grew out of it. While the US or Anglo-American or French perspective is much more, you're in trouble, you just stimulate your way out of it.
So in writing this book, there are 3 authors. One from Germany, one from France, and one from the UK. Were you able to harmonize your perspectives on what was what are the differences, what the real battle of ideas is, and do you tend, say, offline, to all agree on which you would vote for?
Yeah, I think we harmonized. We still have differences. We started out debating these differences. So Jean-Pierre was visiting Princeton in 2011. And
yes, I remember.
And we had some lunches together, and we were debating what was going on and all that. And And I think we harmonized, and I think that's also, I think if we can agree, Europe should be able to agree and find a more common framework. Of course, there will be some differences will remain, but that's also part of Europe, that it's diversity and there's some differences as well. But we have to understand each other, and that's what we try to.
Well, I think the book has performed a valuable function in that you have, what you might call, raised to the conscious level what the dimensions of disagreement and debate among the various countries is about and how it pertains to the functioning of the system. So in that respect, I think we should all be grateful you've provided an excellent roadmap to those who now have to step forward and deal with the unfolding problems of today.
Thanks a lot.
Thanks for being with us.
Great. Thanks.